Welcome to EconVerse, a podcast that breaks down the biggest economic trends and current affairs shaping our world. In this podcast, we cut straight through the headlines to reveal the real impact of economic shifts on businesses, governments, and most importantly, on you. So get ready, tune in, and join us as we make sense of the economy, one episode at a time.
Hey everyone, today we're tackling a topic that's been on everyone's minds lately: inflation and exchange rates.
Yeah, it seems like you can't open a news website or scroll through social media without seeing those two terms pop up.
Exactly. And they're not just abstract economic concepts, they have a very real impact on our daily lives.
Absolutely. From the price of our morning coffee to the cost of that dream vacation we've been saving for inflation, and exchange rates are constantly at play behind the scenes.
So we've got a lot to unpack today. We've pulled together a ton of great sources to help us make sense of it all.
We've got insights from major banks like Chase and HSBC, some in-depth research from the National Bureau of Economic Research, and even some trading perspectives from TastyFX and OANDA.
I'm excited to dig into these and see what we can uncover.
Me too. I think we might even turn some conventional wisdom on its head today. Did you know that sometimes bad news about inflation can actually be good news for a country's currency?
Really? That sounds counterintuitive. I can't wait to hear more about that. But first things first, can we start with the basics? What exactly is inflation?
Sure. In the simplest terms, inflation is the rate at which prices for goods and services increase over time.
So like if that carton of eggs I buy every week used to cost $2 and now it's $2.50, that's inflation.
Exactly. That's inflation in action. And over time, even small price increases can add up and have a noticeable impact on our wallets.
That makes sense. But Chase mentioned that a little inflation is actually a good thing. Why is that?
Well, a small amount of inflation can actually be a sign of a healthy, growing economy. When prices are stable or even falling, it can discourage people from spending and investing.
Because they think they'll get a better deal later if they just wait.
Exactly. And that can lead to a slowdown in economic activity. A little inflation, on the other hand, encourages people to spend and invest their money now rather than hoarding it.
Oh, I see. So it's kind of like a gentle nudge to keep the economy moving. But then why do we always hear about the dangers of high inflation? Where does it cross the line from helpful to harmful?
It's all about balance. Mild inflation, like 1 or 2%, is generally considered healthy. But when inflation starts to rise rapidly, that's when things can get tricky.
Because our money doesn't go as far.
Right. If your income stays the same, but the price of everything you need keeps going up, your purchasing power decreases. You can buy less with the same amount of money.
And that can make it really tough to make ends meet.
Definitely. That's why central banks like the Federal Reserve here in the U.S. work so hard to keep inflation under control.
Oh, right. The Fed, they're the ones who set interest rates, right?
Exactly. And interest rates are one of their main tools for managing inflation.
Okay, interest rates. Can you refresh my memory on how they work?
Sure. Interest rates are basically the cost of borrowing money. When you take out a loan for a car, a house, or even just use your credit card, you're borrowing money that you have to pay back with interest.
So it's like a fee for borrowing money.
Exactly. It's the lender's way of being compensated for the risk they're taking by lending you money.
Got it. So how do central banks use these interest rates to control inflation?
Well, if inflation is running too high, central banks can raise interest rates. This makes borrowing more expensive, which can discourage people from taking out loans and spending as much money.
And that can help cool down the economy and bring inflation back down.
Right. But on the other hand, if the economy is sluggish and inflation is too low, central banks might lower interest rates to encourage borrowing and investment.
So it's like a delicate balancing act.
Exactly. It's all about finding the sweet spot, trying to maintain a healthy level of economic growth without letting inflation spiral out of control.
So we've talked about how interest rates can impact inflation within a single country, but our topic today is inflation and exchange rates. How does all of this play into the global scene?
That's a great question. You see, interest rate decisions in one country can actually have ripple effects across the globe, influencing the value of one currency against another. And that's where exchange rates come in.
How do these interest rate decisions impact exchange rates, the value of one currency compared to another?
Well, HSBC used a pretty cool analogy to describe it. They said that exchange rates are like a dance between currencies with interest rates playing the music.
Okay, I like that. So how do interest rates set the tempo for this dance?
Well, think about it this way. Higher interest rates in one country can be really attractive to foreign investors who are always looking for the best return on their investments.
Makes sense. If you can get a better interest rate in, say, the U.S. than you can in Europe, you probably want to move some of your money to the U.S., right?
Exactly. And that increased demand for US dollars would push up the value of the dollar compared to the euro. It's like a popularity contest. Investors want to hold the currency that offers them the best interest rate deal.
So higher interest rates generally lead to a stronger currency.
Mhm.
But wait a minute, didn't we say earlier that high inflation tends to weaken a currency?
Yes. Quantitatively speaking, high inflation does erode the value of a currency. It's all about purchasing power. If a country's currency is losing value because of inflation, it won't buy as many goods and services.
Right. But then how can higher interest rates, which often go hand in hand with efforts to fight inflation, also lead to a stronger currency? Isn't that a contradiction?
It can't seem that way, but here's the key. It's all about what investors believe will happen in the future. If they have confidence that a central bank is serious about tackling inflation, and they believe those efforts will be successful, they might actually see that currency as a good investment, even if inflation is currently high.
So it's not just about the current economic data, it's also about investor sentiment, right?
Yeah.
Their perception of how things are going to play out.
Absolutely. It's psychology as much as economics. Think about it. If investors trust that a central bank will rein in inflation, they may view that currency as a safe haven and buy it up.
That makes sense, but it's also kind of unsettling to think that something as seemingly concrete as money can be influenced by fear or uncertainty in the market.
You've hit the nail on the head. Investor sentiment is a powerful force, and it can be swayed by a whole range of factors beyond just economic data.
Like what?
Well, things like political stability, for example, or upcoming elections, even trade relations with other countries, all of these can impact how investors perceive a country and its currency.
Wow, this is way more complex than I realized. It's like a giant web of interconnected factors.
It is, and we haven't even touched on everything yet. Another key concept we need to talk about is exchange rate pass-through. Investopedia had some really good explanations of this.
Exchange rate pass-through. That sounds kind of technical. Can you break it down for us?
Sure. Essentially, exchange rate pass-through, or ERPT for short, is the degree to which changes in exchange rates affect the prices consumers pay for goods and services.
So if the US dollar weakens, does that automatically mean everything I buy from overseas is going to get more expensive?
Not necessarily. It's not always a direct one-to-one relationship. There are a couple of different scenarios to consider. Sometimes you have what's called full pass-through, where a change in the exchange rate is fully reflected in the price of the goods.
So like if the US dollar weakens by 10% against the euro, I'd have to pay 10% more for that Italian leather jacket I've been eyeing.
In a full pass-through scenario, yes. But there's also something called partial pass-through, where businesses absorb some of that exchange rate change.
Meaning they don't pass the full cost onto the consumer.
Right. They might adjust their profit margins or find other ways to cut costs so they don't have to raise prices as much. It's a strategic decision for them.
Why wouldn't they just pass the whole cost along to the consumer?
Well, sometimes raising prices too much can scare away customers and hurt their market share, so they have to weigh the pros and cons.
This is fascinating.
Mm-hmm.
I never realized how much goes on behind the scenes before a price tag even gets put on a product.
It's a whole intricate dance of economics. And ERPT adds another layer of complexity to the relationship between inflation and exchange rates.
So before we wrap up today's deep dive,
Huh?
can we try to distill some of the key takeaways for our listeners?
Sure. I think the biggest takeaway is just how closely linked inflation and exchange rates really are. They're constantly influencing each other in this sort of push and pull dynamic.
And that affects everything from the cost of our morning coffee to the value of our savings.
Absolutely. It's a global dance with real-world consequences for all of us.
And sometimes those dance moves can be pretty surprising.
Definitely. We talked about how high inflation typically weakens a currency, but that's not always the case. Remember that counterintuitive example we mentioned earlier?
You mean where higher inflation can actually lead to a stronger currency in the short term?
Exactly. If investors believe that a central bank is taking the right steps to fight inflation, they may see that currency as a safe haven, even if inflation is high at the moment.
It's all about investor confidence
Yeah.
and those expectations about the future.
Right. Which brings us to another key player in this economic dance: central banks. They have a huge impact on both inflation and exchange rates.
Through their control of interest rates.
Exactly. They can raise rates to try and cool down inflation or lower them to stimulate economic growth. It's a delicate balancing act.
And as we learned from Tasty FX and OANDA, Those interest rate differentials, the difference in rates between countries, can create some interesting opportunities for traders in the forex market.
True. But trading currencies is not for the faint of heart. It requires a lot of research, careful analysis, and a good understanding of risk management.
Definitely not something to jump into without doing your homework.
Absolutely not.
We also can't forget about exchange rate pass-through. That's the piece that connects those global currency fluctuations to the prices we see at our local stores.
Right. Investopedia had some great examples of how that works. Sometimes exchange rate changes are fully reflected in the prices we pay, but other times businesses choose to absorb some of that impact to stay competitive.
So the next time I see a price increase, I shouldn't just assume it's all about inflation.
Exactly. It
Okay.
could be exchange rates, it could be supply chain issues, or it could be a combination of factors.
Well, I feel like I have a much better grasp of how inflation and exchange rates work now. It's amazing how much goes into something as simple as the price we pay for a cup of coffee.
It really is. Economics is a fascinating field. It's not just about numbers and graphs. It's about understanding human behavior and how all these different forces interact to shape the world around us. That's a wrap for this episode of EconVerse. If you enjoyed this episode, make sure to subscribe to the podcast on Spotify, Apple Podcasts, or wherever you're listening right now. And if you're watching on YouTube, don't forget to hit that like button, subscribe, and turn on notifications so you never miss an episode. We'd love to hear from you. Drop a comment on YouTube or leave a review on your favorite podcast platform. It really helps us reach more listeners like you. Thanks for tuning in, and until next time, stay curious, stay informed, and keep